Index funds have long been championed by traditional investors, but have fallen out of favor for much of the younger crowd. In this video, we look at what index funds are and how they can be used to build long-term wealth. Let's get started. So what are index funds? Well, a fund is a collection or pool of money allocated by investors, like you and I, for a specific purpose. In the case of an index fund, the purpose is to provide investors a portfolio of stocks or bonds that track a specific financial market index. And an index is just a method to track the performance of a group of assets in a standardized way. An index you might be familiar with is the Standard & Poor's 500 index, or the S&P 500, which tracks the 500 largest companies in the United States by market cap. In the S&P 500, the biggest companies in the United States, like Apple and Amazon, get the biggest piece of the pie. When you purchase a share in an index fund tracking the S&P 500, you are buying a tiny piece of each of the 500 companies. And because the index is weighted by market cap, you get a little more Apple than, say, the 500th biggest company in the index, which today happens to be News Corp. No, I've never heard of them either. Index funds aren't actively managed to outperform the market. Rather, they're intended to track the performance of the underlying assets of a specific index. And in that case, the amount of index funds is only limited by the amount of indexes. Indexes do come in many flavors and can be based on a variety of factors, including geography, industry, and market capitalization. Some of the most popular indexes include the Russell 2000, a collection of 2,000 small-cap, publicly traded companies in the U.S., including popular companies like GameSpot and Crocs, and the United States Total Market Index, which is a market cap-weighted index of 3,700 U.S. publicly traded companies. At their core, index funds are products offered by brokerages like Vanguard and Fidelity that track specific indexes. But why is this a thing, and should we be investing in them? Index funds have a number of advantages over actively traded funds and picking single stocks. Unlike actively managed funds, where a fund manager is actively trading stock, index funds have very low fees. Affordable index funds typically offer expense ratios between 0.2 and 0.5%, whereas actively managed funds range from an entire 1% to 2.5%, and sometimes can go much higher. Index funds aim to match the return of the index and don't need to pay added fees to managers to actively trade. Secondly, index funds are unrivaled in diversification. With the purchase of a single fund, you have the power to invest in a large portfolio of companies, and in doing so, you minimize your risk that the failure of a specific company completely wipes you out. Stock picking can also be very daunting, especially for those who don't have a large amount of time to devote to researching equities, but index funds provide an easy way to passively invest. This kind of strategy is perfect for long-term holdings and retirement accounts. Most importantly, funds tracking popular indexes like the S&P 500 and US total stock market have performed very well over the past 100 years. Over the past 100 years, the S&P 500 has returned a historical, inflation-adjusted 7% average return, and in the past 10 years has returned nearly 14% on an annual basis. But what are the downsides? One of the main downsides is that index funds don't allow for any customization within the fund itself. The fund has to track the index, and therefore only changes when the index does. The added diversification within index funds may also lead to lower returns. Although on average, the winning companies outweigh the losers, there remains a section of the index fund that will underperform and drag down overall returns. Index funds are still subject to the swings of the entire market. Although volatility is lower than in most single stocks, we've seen times where the market has crashed significantly within a single day. With all that said, I believe index funds are a powerful tool that should be utilized in everyone's portfolios. In this next section, I'm going to show you how to build a very simple but extremely popular index fund portfolio that you can use for the rest of your life. Before we get started, consider liking and subscribing. It helps spread the video and support the channel. Thanks. Now let's get back to it. There are tons of index funds out there to choose from, but one strategy has been championed by some of the most legendary names in investing. The three-fund portfolio has been tested by time and has proven to be a low-cost, highly diversified portfolio of 3 index funds. The three-fund portfolio typically includes an S&P 500 or US total stock market fund making up the majority of the portfolio, with smaller percentages going to both a total international stock index fund and a US bonds fund. On the screen, I've included some funds from popular brokerages to get you started. Percentages within this kind of portfolio can be adjusted based off age and risk tolerance. In my opinion, if you're looking to open your first 401k, IRA, or taxable investment account, you should look into building a similar allocation of index funds. Depending on your risk tolerance, you can increase the percentage of your stock-based funds and decrease your bond holdings. If you wanted to start with an even more aggressive portfolio, Warren Buffett has recently stated as part of his 2021 Berkshire Hathaway meeting that only 2 investments are needed by investors, and that's an S&P 500 fund and a small bond fund. The removal of the international fund and the decrease in bonds decreases diversification, but in recent years has proven to be profitable. If you don't believe me, take it from Warren Buffett himself.
I recommend it. I recommend the S&P 500 index fund, and have for a long time to people. And I've never recommended Berkshire to anybody because I don't want people to buy it because they think I'm tipping them into some side. Never. I mean, no matter what it was selling for. And you know, I made it public. On my death, there's a fund for my then widow, and 90% will go into an S&P 500 index fund and 10% in treasury bills.
And I wanted to also ask about all the new index funds with a brain. Are those things really adding value?
No, probably not. The S&P 500 index fund is the one to use. That's the one I used in that bet I made for 10 years. It's the one I've told the trustee for my wife to put 90% of the funds I leave her into. The S&P 500 is, I don't know whether it's 80% of the market value of everything you can buy in this country, and it's over. I think it's over 20 trillion. And you're buying America. And let me give you a figure that'll blow your mind. I think I bought my first stock when I was 11 years old. It was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75. Three shares, $114.75. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today.
Oh man,
$400,000.
Oh.
So if I, as a little kid, had taken that $114 I'd saved shoveling snow or whatever I'd done, $400,000 today, one person's lifetime. That's America. I mean, that isn't me. It is the huge tailwind the American economy gives to any equity investor. Now, the market's gone down many times during that time. People have panicked during that time. Headlines have been terrible. It looked like we were losing the war when we first bought it. But America is a powerful economic machine that since 1776 has worked, and it's going to keep working. Now, you don't want to buy to hold for a year. You don't want to buy with the idea that you could sell it in 2 years or 3 years, necessarily make money. You could lose money that way. But if you buy it for 10, 20, just keep buying the S&P 500 index and forget about all the other nonsense that's being sold to you, because I'll guarantee you one thing about the stuff being sold to you: it will carry bigger fees than what I'm talking about.
Yes.
Yeah.
And there's no reason to think that we don't know if it's 400,000, but that same sort of process or returns won't happen starting right now.
The S&P 500 companies have earned well over 10% on equity, often 15% annually for years and years and years and years. They've done it with Democratic administrations, with Republican administrations. Now, you get money compounding at that kind of rate underlying your investment, and you get a diversified group of that. I mean, you're going to do well.
Index funds are just one of the many powerful tools we can use on our way to financial freedom. Subscribe for more videos on investing in the stock, crypto, and real estate markets. Take care, guys, and thanks for watching.